In this video, we're going to talk about a brand new SPAC that just merged called LOTZ or car lots, okay? And one analyst thinks this can jump 175% from here. And by the end of this video, I want you to let me know in the comments below if you agree with this analyst or if you think they're missing something, okay? So let's just jump right into the article. It says, when a company wants to refresh its car fleet, the first it must do is get rid of the cars it already has and make some room in the corporate parking lot. Historically, this happens on one of two ways. First, the company puts its cars through an auto auction or sells them in bulk to a wholesaler. Then a retailer buys those cars at wholesale prices. Finally, the retailer spiffs them up, marks them up, and sells them to you, the consumer, or me. But are all of these steps really necessary? What CarLots does is they have a consignment to retail business in which corporate vehicle sourcing partners, fleet leasing companies, rental car companies like, Enterprise or whatever, banks, and other corporations often found in possession of large numbers of cars that they want to unload quickly. Hand their inventory over to CarLots in this consignment type thing. Then CarLots does any necessary reconditioning itself, sells the cars directly to consumers, collecting fees worth between $1,200 and $1,700 on each vehicle sold. Now, the really cool thing about this model is that CarLots doesn't have to spend millions, and I'm talking millions of dollars on vehicles to stock their lots. Okay, they do trade-ins and things like that as well, but this sort of business model is being done out there, just not at the scale that CarLots is doing it. Okay, Barrington analyst Gary Prestopino points out that CarLots is the only company taking such a consignment to retail approach to car buying in the United States. As the analyst explained, CarLots' business model disintermediates wholesalers, wholesale auctions, and dealers while offering retail customers an omni-channel experience for vehicle purchases. CarLots cuts out the middleman and permits car buyers to buy more or less directly from corporate fleets that are looking to unload their old cars, with sales conducted either in person or online. In so doing, the analyst notes, CarLots is able to pay its corporate clients an average of $1,000 or more per unit sold, while saving consumers $500 to $1,000 on cars they buy, relative to the prices charged by traditional used car businesses. I did look into this, okay? I went to CarLots' website. I checked out their inventory. I compared it to some of the other, like Cars.com or Auto Trader or some of these others, and they are in, as a standard practice, cheaper than some of their competitors. So I think this is something that will catch on. But again, I want you to make that decision, okay? Let's jump back over to the article. It says, you can see how that would be an attractive proposition to both sides of the equation, and indeed, it's turning out that way. From 2017 through 2020, CarLots revenue surged nearly threefold in size to just under $119 million. The company isn't yet profitable, but its losses did fall by half between 2019 and 2020, and CarLots is continuing to grow, with Prespatino noting the company plans to open 14 to 16 sales hubs, combining reconditioning facilities, consignment centers, and showrooms in 2021, and more than 40 by the end of 2023, versus just 10 hubs that it has at present. Now, they just actually opened their 11th. I want to jump over to another article here. CarLots Nashville is now open. This article is from yesterday. So they do have an 11th lot open already. Let's jump back to our analyst article here. It says, even then, that probably won't be the end of this growth story. By 2023, Prespatino projects that CarLots will be moving metal at the rate of 80,000 units per year. That would be an almost 13x the amount of business it is doing today, but still only by about 1.1% of the total corporate fleet resales that year. And this implies that after quadrupling over the next 3 years, there will still be the potential to grow nearly another 100x in size. Now again, I want to highlight this part. It sounds like they're only tapping into right around 1% of the corporate fleet. Now, if this is something that drives more revenue, that lowers losses of, buying these vehicles, these fleet vehicles on the corporate side, companies will jump on this bandwagon, and car lots, they won't have a choice but to create and open up more facilities because they're going to have so much more revenue. So once this starts making a lot of sense to these companies that have these corporate fleets, I think this is really, really, really going to take off. So he's saying, how much is this opportunity worth? The rating on car lots right now is outperformed. Presbytino sees the stock surging from its current share price of $8 to $22 over the course of the next year. This leaves room for 175% upside potential. Now, I know that you're used to, 4 months ago, 175% in a week. Why should you have to wait a year for 175%? And I get it. I understand. The market's a little different right now. 175% over the course of the next year or even last year was fantastic. So this could be a potential good opportunity. Let's jump right back into the article. It says, Car Lots summed up. We believe that Car Lots offers a compelling value proposition for both vehicle buyers and sellers, offering a transformation growth opportunity in used vehicle retailing with a business model that is disintermediating traditional means of used vehicle remarketing. The company is rolling out a national presence to drive a network effect that should enhance shareholder value on a long-term basis. Judging from the consensus breakdown, it has already been relatively quiet when it comes to other analyst activity. Over the last 3 months, only 2 analysts have reviewed lots, both of which, however, were very bullish, making the consensus a moderate buy. On top of this, the $22 average price target puts the upside potential at 178%. So right there, that's essentially the article in a nutshell. Some of these analysts do a fantastic job of checking out this company. If you don't know what TipRanks is, just check it out. It's a great website. And the 2 people that did analysis on this have either 5-star or 4.8-star rating on TipRanks. So they tend to be really, really good analysts. So just kind of keep that in mind as well. So, but let me know down in the comments, what do you guys think? Do you think this is a good opportunity? Do you think this company is going to grow like they say or they want to grow over the next few years? I don't know. Up to you guys. Thank you so much for joining me for another video. I appreciate it. I'm sorry I didn't get this out yesterday. I hope my internet's better. It was better earlier, but if it's bad again, all right. Thank you guys so much for joining me for another video. I appreciate it. As always, if you didn't already do it, click that beautiful red subscribe button down below, and I'll see you in the next video. Thanks.